Hey guys, Nathan here from FX Education. In today's video, I'll be teaching you how to find and draw good levels using dynamic support and resistance, as well as showing you a checklist that you can run through when placing your support and resistance on any chart. Before we dive headfirst into talking about dynamic support and resistance, let's first take a moment to consider what normal SR is. A level of structure is just an area where prices reacted to previously. What determines whether the level is support or its resistance is where price currently stands. A level is resistance if price has rejected this level previously and is now underneath said level, and a level is defined as support if price has rejected this level previously and is now above that level. An easy way of remembering whether a level is support or resistance is that the support acts like the floor and resistance acts like the ceiling. The reason that we always look for support and resistance in the market is they help us to identify potential turning points in the market. A step further from this is looking at different types of support and resistance. Many people in the trading industry use the same terms to explain different things, so I'll just break down what each means for me. A level of support or resistance is just an area of structure. Variable support and resistance is using a moving average as a potential area of structure. Implied SR is using a tool to predict future SR levels, such as a Fibonacci retracement tool. And dynamic SR is an extension of the regular SR, and it is just looking for an area of price is likely to be used as a previous level of structure again, but now as the inverse compared to the last time. To explain this a little better, we always need to remember that if a level is currently being respected as resistance, there is nothing stopping it from being broken and retested as a level of support in the future. This is what a dynamic level of SR is, looking for a level where price is likely to respect it as both support and resistance. Before going any further, one great tip that I want to give out straight away is about the importance of isolating a zone and then placing a level within this zone. Hopping onto our example here from EUR/USD, we can see price currently trading between these two levels. However, if we zoom out and take a look at how these levels fare in previous times, we can see that they are a lot less precise with a lot of noise around these levels. Drawing a box around this area, we can see that our area of interest actually encompasses quite a lot of the market structure. And if we want to trade this level, we're going to have to be a little bit more precise. This is where a great technique comes into play, placing a level in the mean of the zone. For those of you who may not understand this, basically you want to take the high of our box, the low of our box, and subtract the lower number from the bigger number, which gives us the range of our box, or how many pips are between the high and the low. If we then divide this by 2, we can use this number and either subtract it from the high or add it to the low to get the middle point of our box. The middle of our box is what I mean when I say finding the mean of the zone. Placing a level at the mean of the zone, we can see this actually works quite effectively, and in our most recent touch of our area of interest, we bounce straight off of our level. Doing this same thing for the other areas of interest on our chart, we can say that this works time and time again. There are a few easy criteria that helps us to find good levels where a price is likely to be used as dynamic SR. These are obvious levels, swing points, multiple rejections, an area being used as dynamic SR before, and strong momentum away from an area. Now, let's take a look at our criteria, starting first with obvious levels. The first factor is looking for obvious levels in the market. You need to remember that there are no brownie points for finding the most obscure levels in the market, and that you need to be focusing on the levels that a lot of market participants are also identifying, so that there are a large number of market orders placed at these levels. Taking a look at EUR/USD, we can immediately see there are a few obvious levels that jump out to the eye. Using again our technique of isolating the zone and then placing our level in the mean, we can quite easily find a few areas where there are a few potential areas of interest. There are a couple of other areas that also could be suggested as potential areas of interest, such as this one at the 120 to 124 mark. But when placing our level in the mean, we can say that the price has recently not respected this level at all, and hence I would deem this level a lot less obvious than the others. Playing this forward, we can see there are a few good opportunities to place some great trades at our areas of interest. But as we get into our less obvious level, things get a little bit choppier as we expected them to earlier. This just highlights the importance of sticking to obvious levels, and playing this a little further, we can see a few more great trade opportunities from our obvious levels. The second factor is looking for swing points in the market. These swing points are extremely useful as they show the points of previous moves where momentum finally exhausted. You may want to mark the extreme swing points on your chart as well, which could be the highest and lowest points on your chart. This really does go hand in hand with the obvious levels part, as obvious levels tend to be where the swing points occur, so I won't go into this in too much detail, but it's really important to be aware of. The third factor is looking for multiple rejections of an area. This means that we like to see the level being tested a few times so that we know that it is a good level to trade around. However, this doesn't mean you need to go short if you identify a level of resistance that has been tested 20 times, as there is likely to be a reason why price is persistent at this level, and often this will result in price breaking through in the near future. Comparing the two scenarios here, we can see one where we're in a trending market and one where we're in a ranging market. Here, multiple rejections of our level of resistance happen before price breaks through to the upside, in a classic break and retest example. Although the multiple rejections here show that the level is a good level to trade from, the context of the uptrend suggests that it will be good to use the level as dynamic support rather than trading off of the resistance, as we always want to trade with the dominant trend. Looking to our ranging example, we can see here that there are a lot of potential for trading off of multiple rejections or swing points. As in a non-directional market, price usually grabs for liquidity above the resistance or below the support, but falling back under the resistance or pushing back above the support. In this context, multiple rejections tend to indicate a stronger range, and you could trade the multiple rejections a lot easier than in our uptrend example. The fourth factor is looking for levels that have been tested as both support and resistance. This makes perfect sense, as if we want to find areas of interest that are likely to be dynamic, using areas that have previously been dynamic support and resistance is likely to lead to a good outcome. When utilising this criteria, a really useful hint would be to adjust your levels depending on where price was last, before it broke through this level. This sounds complicated, so let's get straight into an example. Looking at the chart of the Dow Jones, we can see that we have an area of interest just here, and placing our area and level in our usual fashion, we can see that we have just missed an entry around here. However, if we adjusted our level to where price was last, just before it broke through, i.e. around this resistance just here, we can see that we would have been tagged into this trade and currently be sitting in a healthy profit. Looking at another example, this time on Euro Swiss, we can see that our usual area of interest and level placement. However, if we had entered a short position off of this level, we can see that although we didn't hit our stop loss, we would have been sitting in drawdown just for a couple of hours. This of course does hamper our psychology, and since we want to avoid this. However, if we adjusted our level to where price last was before it broke through, i.e. where this level was used as support just up here, it is easy to see that our drawdown would have been a lot less just because of this small alteration. The final factor is looking for levels that have been resulting in price moving away from the area with good momentum. This means that the level has been respected properly, and there are likely to be a lot of orders that were triggered at this level, suggesting it was an area that a lot of traders are watching. This is a fairly easy criteria, so we won't delve into it too much. To just recap, we have 5 factors that we can look for when placing our dynamic SR levels. These are obvious levels, swing points, multiple rejections, areas previously used as dynamic SR, and price moving away with good momentum. Also, we had 2 top tips given out throughout the video, which are isolate our area of interest and then place the level at the mean of this zone, and adjust your level slightly dependent on the last point the price respected the level before it previously broke it. The best way to analyse a market is not to use all of these things individually, but rather combine them together into your analysis and use them in confluence. For example, a level that is only a swing point is likely to have less strength than if the swing point had also been rejected multiple times previously, and price has moved away from this level with strong momentum before. The key to using these levels properly is to use the criteria in combination to try and find great levels to trade from, rather than try to use them by themselves.